Justin, hi, welcome.
Hello, Nick.
Video number 4 in our most recent series of M&A videos. And the idea of this particular video is to give people some ideas, some guidance about what they should do if they've decided they want to sell their company, their business. Where should they go? Who should they ask? Who should they speak to? Is it their accountant? Is it their lawyer? What's the process? And what would your advice or guidance be for me, the person who's been running their business for a few years, decided I want to exit? Who do I pick up the phone to?
So, good question. I think the starting point really is to get sort of, educated on the sales process itself, because, most people having a company won't have sold a company. So,
Sure.
Go on YouTube, go on Google, and start Googling around. I think the second point really is to understand the size of the business that the owner has, because the size of the business dictates the kind of support or the kind of people that you're looking to use.
Yeah.
So by size, typically we're talking about profit. The more profit a business makes, then the more likelihood is you can employ a crack professional team of people to sell your business. The smaller the business is, it might change the options. So, typically there are probably around about 1,000 companies in the market in the UK that sell companies. So you have accountants, you have business brokers, you've got corporate finance firms, you've got mergers and acquisitions professionals, you've got investment banks. So it's a real plethora of companies that you might choose. So if you've got a small business with profits of, let's say, than £1 million, that's a real threshold in the market that we see. So at £1 million profit or beneath, buyers, the number of buyers for that particular company drop away a little bit.
Right.
And the reason being is quite straightforward, because it's expensive to buy a business. So a large company buying a company only really wants to invest and spend that money when the target, the selling company, is a sufficient size, if that makes sense. So £1 million is a threshold that we typically see in the market, saying, well, beneath £1 million, then the routes to market to sell your company are typically business brokers.
Okay.
A business broker is the business equivalent of an estate agent.
Okay.
So it's a fairly transactional approach, and there's plenty of business brokers. There's some national ones, there's some regional ones, there's some local ones. And the process is quite straightforward. You sign up, you pay a little bit of money, they'll produce a teaser, they'll produce a small information memorandum, and typically they'll screen their database for people that they think might be interested, and they'll contact them. And often that's an email blast for 5,000-10,000 people saying we've got a company for sale, or they might put it on a website saying business for sale.
Yeah.
But the point being is that at the smaller end of the market, it's a very transactional approach. Okay, so business brokers would be typically the route to market. Okay, once a business is at £1 million profit and north of that, the options open up significantly.
Okay.
So the options open up to typically use M&A firms, corporate finance firms, larger specialists that specialize in selling, sort of medium-sized companies and above. And that gives you a different playing field altogether. So if we talked about the small end of the market, it's what I call a mass approach. Okay, the business brokers go out to lots and lots of different people saying, do you want to buy this business? But when you've got a business that has more profitability, typically you're approaching the market in a much more select way.
More tailored.
Correct, yeah. And it's the difference that I like to compare against, let's say, the recruitment industry. You have a recruitment industry where you're recruiting lots of different jobs, or you have a headhunter. A headhunter is somebody that selects individuals and targets individuals in companies to go and hire them and place them on behalf of their clients. And it's the same with selling a company that has good profits. Okay? Usually the right way to sell that business is to be very, very selective and to target very specific buyers that have an appetite to buy in that sector. Okay?
Sure.
But to do that, you're going to need the M&A firm or the corporate finance firm or a large accountancy firm, etc. So this is where, of course, it's more expensive to transact at that level because, of course, somebody selling a company has to spend more money on the advice, on the specialism, if you like. But I think the summarise is, one, get educated on the process, what's involved. B, know the type of business that you've got in terms of where your profits sit and who's likely to be the right kind of fit. Knowing that stops a lot of what I call dead-end conversations.
Yeah.
So having a business, let's put some metrics around it. You have a business turning over 3 million, profits of 200,000, nice business. Okay, so making the telephone calls to some investment bank to sell your business, is going to result in a lot of wasted effort because they're going to say, listen, it's going to be 500,000 to sell your business plus, because we've got a big team, we're very select, and we put a lot of work into this. Okay, so knowing the size of business automatically decides to a degree who you're going to try to use, if that makes sense. So that's the starting point.
Absolutely. So when we're looking at the kind of SME level, which is where you and I operate quite a bit, and you're looking at businesses with an EBITDA profit level of £1 million and above, what is the best suited route for those businesses? Investment bank's not going to work, business broker's not going to work. You're into the corporate finance, M&A, kind of boutique-y firms, would that be right?
I think that's a fair way of putting it. I mean, it's obviously I'm slightly biased because we run a boutique. We're a micro boutique, if you like.
Okay.
But it is, our service is much more tailored towards being an investment bank type of service, and explaining that in plain language. Plain language is if I use the term business broker. A business broker is not there to help a company get ready for an exit. A business broker doesn't usually sit with the business, ironing out all of the housekeeping issues and understanding the business at a very detailed level. They don't do that piece. It's transactional. Think of a house sale with an estate agent.
Yeah.
They turn up, they do the brochure, out she goes. So once you get to this smaller segment, M&A firms, good corporate finance firms, that's where the value that they add. They do the preparatory work at the beginning, helping the company get ready for sale, understanding the business in some considerable detail, and doing very, very, very detailed market research to find potential buyers.
Okay.
So the answer is, I am biased because, of course, we see that that's the type of work we do. So we're investing 100 to 150 man days in research, for example, when we take on a project to find buyers.
Yeah.
It's a big investment. Yeah, it's a lot of work, 3 months worth of full-time work for a team of 2 or 3 people just to find potential buyers. Okay, so the advantage of this, of course, is, if you're selling a business with an enterprise value of 20 million, the final deal value that you're likely to achieve really sits on the quality of the preparation, the quality of the research that's done, the quality of the presentation, having the right buyers in the room, and some of those buyers might come from overseas countries, and very often do. So often we're searching,
globally,
15, 20, 25 countries
Yeah.
to find that buyer list. So to simplify it in a sense, even with bigger companies, there's a big choice of who potentially could sell a business. But actually, once you start narrowing it down and saying, okay, now just give me a subset of the very, very good quality companies that can do that. Now we start to produce that 1,000 companies, if you like, all the national accountants and the business brokers and so on. We start to funnel it down to a much smaller number. Now, it's not a handful of people, but it's certainly, it's dozens of credible companies across the UK.
Sure.
That are really, really very, very good at actually the quality of the work they do. And it makes a huge difference, in my opinion. I've bought companies and also sold companies professionally for 15 years. It makes a huge difference on the outcome. So the answer is there is a big choice, but actually when it comes down to it, when we're talking about the place where we work, we have enterprise values 5, 10, 20, 30, 40, 50 million pounds, and north of that you've done 300 million pounds.
Sure.
Yeah. Then the quality of the advisors that are doing that work pays demonstrably when it comes to the deal at the end. Is that your experience?
Yeah, definitely. I think, as you say, there are certain deals that certainly as in our firm we're just not involved in. Listed deals beyond typically 100 million, in terms of enterprise value. We're not really operating that regularly above that level. We are typically in the owner-managed SME space. So, enterprise values 1 to 100 million is probably our sweet spot, and that's where we do most of our work. And we're familiar and experienced with those sort of transactions. Just moving the conversation on a little bit, you talked about the 2 to 3 months investment of time in terms of research, finding a buyer. I know what an information memorandum is.
Yeah.
Just for the benefit of those who may not know, just tell me a little bit about what that is, what purpose it serves, and how it can be used and why it's useful in the process.
Yeah, it's a great question. Well, the information memorandum actually is a technical document.
Okay.
So it's a little bit different to, let's say, selling a house and having your brochure, your 2-page open-out brochure. Typically, the information memorandum is 10, 20, 30, 40 or more pages. And it's a technical document mainly. Okay? It's mainly there to present the business and to describe what it does, for whom, how it adds value. And it's typically breaking that down in quite detailed levels. Okay? And the reason it's a technical document, generally speaking, is if you're presenting it to buyers, so particularly international buyers who might not actually visit the company that they're looking to buy, the only thing that they're going to receive once they've signed a non-disclosure agreement is the information memorandum. So that's it's almost the Bible to the business.
Sure.
So it's got to describe it at a sufficient level of detail that a buyer could say, yeah, I've got it. I understand exactly what the business is about. And it's almost answering a lot of the due diligence questions that somebody might have. What are the margins in the business? What are the margins in the product lines? What markets are you serving? What products are you producing? And.
Sure.
So the IM is a very comprehensive document that literally presents the business. Now, I say it's a technical document. So, of course, overlaid on top of that is putting on the presentational aspects of the company you're selling. So from our point of view, we want to make it so that nobody receives it and says anything other than it's a world-class document. So it's got to look good. It's got to look and present well. And of course, the idea is that you're presenting the opportunity of the business and showing how it can perform under new ownership.
Yeah.
It's a really key point.
What's the opportunity? Absolutely.
What's the opportunity? Because, a business, SMEs, typically this is the space we're operating in, right? Mm-hmm. So a private business owner might have run a business, with certain criteria in mind. Yeah?
In a certain way for so long, I want this much out of the business. So long as it's doing that, I'm quite happy with it. That's not going to be enough for a buyer. A buyer's buying a business typically because they want to grow it. They see an opportunity. They want to generate more profit. The IM presumably has to help take the buyer on that journey and provide a bit of persuasion as to, well, this is what the opportunity is.
Yeah, and very often it is the case. We use a phrase in corporate finance, adjusted EBITDA. It's a wonderful phrase. I've actually got a mug with it written on it. But what does it mean? It means that, a business will be run by a private owner with a certain level of profitability and a certain amount of costs going into a business. You sell that business to another buyer, a professional, let's say strategic buyer, large company, the profit will change. It could go either way. It could go less or it could go more. So the idea is saying, well, what does it look like under new ownership? And if you can model out, for, let's say, a very specific company, let's say a company that makes widgets, and turning over 20 million. And you're saying, well, actually, your ideal buyer is going to be somebody making widgets but turning over $1 billion. Okay? Then we can get clever and start to model out financially to saying, well, if you have their buying power, if you can buy at the same rate they can, what difference is it going to make to your bottom line?
Sure.
It's an example.
Yeah.
But we've seen this actually play out in deals we've done where large strategic buyers have brought in enormous purchasing power advantage. And in one case locally, we had one where it doubled the bottom line, literally from day one.
Amazing.
Okay, so this is the type of thing that will go into an IM. And so it's quite a technical document. It's detailed. It has to model out what it looks like under new ownership. And of course, it has to sell. One of the key things in my view, and this is the difference between hiring seasoned M&A professionals, is this notion of selling something. Not just a technical document in terms of the overall sale, is what you really need is somebody that's going to sell the opportunity. Yeah. So it really gets the decision-making people at the top of these very large organizations. We deal with some that turn over billions. We need them to really see the full picture of how buying that company is going to make this famous thing called synergy, and it can work. So that's the job. That's basically the job of the IM, and of course the people that support it in selling it.
Brilliant. Yeah, that's really, really interesting. So moving us one step forward, the IM's out there, you've had expressions of interest, you reach the stage where a couple of offer letters have arrived from prospective buyers. What's the process from that point? What do you do in that process that assists the seller?
Yeah, so once we have those ideally multiple offers on the table, the goal is to optimize the offers. And, I know that people watching the video, including buyers, will think there's some sort of, mystical art that goes on here, but it's not. I mean, typically we never present a company with a guideline price. It's a rookie error to do that. That happens in the small business segment, but nothing when you come to really good sized deals. So the idea being is you let the market decide. But of course, when those initial offers come in, typically they'll have a range of values. They'll have a range of different deal structures. And by the time, if you like, we have those letters of intent on the table, we've already put in a lot of work with those buyers, that senior management team, the chief executives, the presidents, and so on. They've got emotional skin in the game. Because by the time those offers have come in, those large companies have taken it through their board approval process. They've examined it really carefully. They've asked their management teams inside their companies how this is going to fit, this acquisition. So in other words, they're already some way on the journey by the time that letter appears on our desk with the offer. So of course, if you're saying, where does the value we add? The value is in the negotiation.
And the value is in producing the offer, right? Because the buyer it's not legally committed at that stage, but there is a commercial commitment. They will have incurred cost to get to the stage of being able to issue an offer. And actually it's at that point that the seller can evaluate, what do we do from here? Because the seller may say, well, actually, yes, those value ranges that you describe are, they meet my expectation, therefore I'd like to move forward. Or unfortunately, in some cases, I suspect the value ranges don't meet the seller's expectation, and it's kind of, you draw stumps at that stage, I guess.
You raised a really good point. I mean, if you, certainly at the lower end of the market, it's not difficult, Nick, to get offers for a business. There are lots of financial buyers out there that, and most, let's say, M&A investment firms will know who they are. It's easy to get offers. The question is, how easy is it to get a good offer?
Yeah.
So you're absolutely right. The job in hand that we do, as a business, we probably aren't alone, but we screen out right from the off, the chaff. We just actually screen it off largely because we just don't deal with it.
The opportunistic buyer who's just looking for a deal.
Yes, correct. We just don't deal with those types of buyers. So we're only going, typically, 90% of it is strategic buyers, 10% is private equity, I would say, with the type of work we do, mostly because the owners are looking for a full 100% exit.
Yeah.
They don't want to be on the journey downstream, which is private equity's interested in.
Yeah.
So, I mean, in a sense, by the time we get to those letters of intent, we've not dealt with any of the low-end stuff that some other companies deal with, and we've already talked about the deal structures in advance with the buyers to optimize those, so we, again, weed out those that we think just simply won't work. And of course, deal structures can come in all sorts of different flavors.
Of course, yeah.
My personal favorite and preference is simple. Cash is always king, but I know it's a bit of a sort of a simple way of approaching things, but a lot of the deals we do are genuinely 100% cash completions. Sometimes with a little bit of money left over for covering warranties and indemnities and so on.
Yeah, bit of retention.
Bit of retention. But basically, I would say that the key value add, if you like, is negotiating the right deal structure and optimizing the price. And sometimes we've had, I can only speak for our business, we've had transactions where we've achieved multiples. I'm thinking of one where we both dealt with it, where the exit multiple was 10 times EBITDA. The average national standard for that was about 4.5. So it was outstanding. Now, I'm certainly not going to go on record and saying that happens every day of the week. It doesn't. And so one has to be very mindful about, over-promising, if you like. But with a well-designed process, time spent up front with a good M&A firm, actually there is the chance that one achieves really, really high multiples purely because of that time and expertise put up front.
Absolutely. Yeah. Okay, great. So let's take it another step forward. We've had the offers. Yeah. We've had the negotiation with the buyer. The seller's happy. The offer letter's signed. Where do we go from there?
Once the offer letter is signed, so we call it heads of terms. So normally at that stage, the seller has to then engage some legal, tax and accounting support. So most people that are selling companies don't actually, support the due diligence in coordination, but they don't support it in answering questions. Okay, so the seller will need a professional team of people behind, and I think I always advocate, and you know this, is get the best possible expertise. There is tremendous value, even if it costs money, in having an excellent corporate firm such as Steele Raymond supporting you in that process. You know, get good tax advisors and so on. So from that process, you sign heads of terms, then you go into due diligence. The buyer will send in their teams. They'll do legal, financial, and tax due diligence. It typically takes 2 to 3 months. And in parallel of that process, the sale and purchase agreement, or the business, or if it's an asset deal, will also be produced. So in other words, the sale document.
Yep.
And then at the end of that process, ideally, is the seller signs that sale and purchase agreement, and the deal is done. The deal is consummated. But of course, in that 3-month period, typically, can be longer, there's a lot of work.
Yeah.
As you well know.
Yeah, and the potential, I suppose, for challenges to arise. The due diligence process we've talked about in other videos. It is scrutinising, it is forensic. A prudent buyer will be lifting up every stone and having a look underneath. They'll be looking for skeletons in the closet, particularly for businesses which have been running for several decades. We've talked about the importance of having a look at that stuff before you get into the process. But yeah, the due diligence will take a bit of time and will inform the content of the SPA, which is, you've mentioned, will also take a bit of time to negotiate. I'm just trying to get a feel for timeframes here for people who might be watching. So if we go back to the very beginning where the seller initially instructs, let's say they've got a business that's £1 million plus EBITDA, they're going to instruct a firm like yours. That's the very first step. We've then got probably 3 months of research. We then hopefully get to the offer letter, heads of terms. There's another 3 months worth of due diligence, maybe allow a little bit of slippage, say another month. We're talking there, start to finish, about 7 months. Would that be?
I always guide clients 12 months,
Okay.
allow 12 months for it. I mean, we've done deals in 6 months, and some have taken longer as things come up.
Yeah.
On average, generally 12 months is the kind of timing. And the reason being is because ideally, if one runs at a certain pace, there's lots of things that need to happen at certain times to keep pace behind a deal. And sometimes those don't happen for the best will of the world. And it might not be nothing to do with us. It could be to do with all sorts of reasons. Holidays, it's a typical example of that.
Yeah.
August in the UK, people just go away these days. We're very continental in our approach. So I always say, allow 12 months. Allow 12 months. And I think just to add something to the point you raised about the due diligence process, it's a point where, at certainly the lower end of the market, the goal of, I'm going to use business brokers if you like, the goal is to get heads of terms agreed and then hand it over.
Yeah, it's milestones, right, in a deal.
It's a milestone, and hand it over. And so basically, they'll hand it over to the seller and go, right, it's over to you, and the due diligence will happen, and give us a call when the deal's finished, if you like.
Yeah.
As some sort of framework. And so what you're going to find with really good quality M&A firms, good corporate finance firms, is that they stick with you from the heads of terms all the way through to completion, and not only coordinating what's going on, but adding commercial value. Because a lot of the due diligence that comes in can be screened and can be, let's say, managed in a way that is going to help the deal complete better than before. But yeah, I mean, basically, I always say 12 months, might take a little bit shorter.
Yeah. It's interesting because from our perspective on the legal side, we are not involved with the very early stage process that you're involved in. We're not involved in the market research, the finding the buyer, the preparing the IM. An awful lot of work has gone into a deal by the time it typically lands on a legal desk, essentially. Probably from heads of terms, which we like to be involved in. We like to help draft those. We think we can add value, but we're not always involved. Sometimes clients may deal with it themselves for whatever reason. But we would say from that point, we would typically see a 3-month timeline. That would be typical. We have seen some deals lately where at the higher level, where there's been significant debt raised by a buyer, that's had a really negative impact on timing. This was going back to the period pre-Christmas where there's quite a lot of froth around interest rates and all that sort of stuff. The debt market at the higher level was very, very difficult, and that sort of slowed things down. Other factors can include who the buyer is. If you've got a buyer who's in a jurisdiction outside of the UK, sometimes that has a timing implication. We've done transactions before with Chinese buyers. Chinese buyers are beyond a certain level, have to get a government approval for certain amounts of money to leave the country. So you sometimes see a delay there for that. So there's lots of factors which can play into timeframes. Sellers are very keen to have a feeling for timeframes. I think that an open-ended time frame is unhelpful because people can't sort of see the destination. People want that certainty, which we understand, and we try to give those guidelines. But sometimes there are factors which are outside of anybody's control.
I agree with you, Nick, and I think this is part of the getting educated piece at the beginning, because the more that a seller understands what the sales process looks like, it's rare that a seller is going to have had the experience of having sold a company, right?
Sure.
So probably the nearest thing is selling a house. That's probably the nearest high-value transaction that somebody could anchor their thoughts in. And of course, selling a company is actually infinitely more complicated. It's just what it is. There's a lot more complexity to it.
A lot more moving parts.
There's a lot more moving parts. So, basically, the more they can get educated about it, the more they can have some sense of awareness of what's going to happen at each particular stage of the process. Yeah. But I think to broadly summarise it, there's a plentiful choice as to who can sell a business in the UK and overseas, if you like. But once you start narrowing down, the two key factors are profit. But once you get above that 1 million profit threshold, then basically my personal view is, be very selective. We're not the only firm. We do a good job. I'd be arrogant to saying that we're the only firm that can do that. Clearly not. Yes, but there are a much smaller number of firms that really are exceptional at getting deals over the line. And to give you some statistics, there's some, I've seen this twice, and it looks to stand up that roughly about 80% of companies that come to market in the UK do not sell. It's a horrifying statistic. It says, well, okay, only 20% that come to market do. Now, why don't 80% sell? Well, there's a plethora of factors, loads of reasons that can go into that. But undeniably, the quality of the people that are working on the project to get it sold makes a massive factor. Just has to.
So, Justin, let's hypothetically, scenario is, I want to sell my company, I want to sell my business. I've engaged you or somebody else. The first thing that I really want to know, if I haven't sold a business before, is how do I value my business and what is my business valued at? Because I might think I want to sell, but if a valuation comes back that it's worth 50p, I might change my mind. I might be pleasantly surprised somebody comes back and says, well, actually it's worth 5 million quid. Great, let's crack on with the process. But how does that sort of standalone valuation work? Is that something your firm would do? Is it an accountancy firm point? And when and how does somebody go about arranging that? Just give us a bit of insight on that.
Yeah, so great questions. So there's two different types of valuation in my experience. The first valuation is an accountant's valuation. Okay. And these are typically done for tax purposes. Okay. So an accountant will value a business, we're talking English money, at pounds, shillings and pence. Yeah. Yeah. So they'll say your business, Nick, is worth, £255,413 and 10 pence. That's good, wasn't it? But the reality is it's not a market valuation. Okay. So an accountant will look at it, take a range of variables, and honestly, it's a finger in the air, but it's good for tax purposes. Often it's not HMRC. If it's done by a chartered accountant, would say, well, it's good for that purpose. But it's not a realistic market valuation. So the answer is any competent company, we would undertake that work, would provide a range. Because that's the reality. What a business is worth is only known at the point that a sale and purchase agreement is signed, done and dusted. And so how do we estimate that? Well, we take a number of different metrics. So one, we fix the methodology of how we're valuing a business. Usually it's a multiple of profit, a multiple of EBITDA. That's the conventional way of doing things. Yep. So we draw on a lot of market data, previous transactions, for example, in a particular segment. We can look at the market and saying, on average, if we draw a standard distribution curve, where an average sits for an industry, where the peaks sit, where the minimums sit. Okay? And we have to understand that nobody can guarantee where it would sit, the actual final multiple, if you like, until the business is taken to market.
And that's down to the buyer, right, or the buyers, because there is market data, that shows us historically what buyers have deemed appropriate to apply to a certain business. A certain buyer may turn around and say, well, actually, to me, the multiple's X, or another buyer may say, well, it's Y.
Correct.
And then it's a case, I assume, of the seller saying, well, that's acceptable to me, or no, it isn't. So there's no there's no defined prescribed mechanism that both seller and buyer have to adhere to. Right. You've got ranges and parameters. Ultimately, it becomes a negotiation, I guess.
It's a negotiation, but where the skill, if you like, I should be arrogant enough to call it skill, is in presenting the selling company in a way that gives the buyer the rationale to up the multiple.
The justification.
The justification, yeah. So this is all the constituent bits of what an M&A firm do.
Yeah.
You know, it's in the IM showing how that business would fit in the buyer's organisation and where the value would add. Okay. The more that we can present this strategic benefit, the higher on this standard distribution curve, we shift it to the right on your side, sorry. We shift the multiples up.
Yeah.
Okay. The other way to shift the multiples is through competition. You know, there's no doubt about it. I mentioned a little earlier, is, you know, by the time we get to letter of intent, yeah, there's quite a lot of emotional and time and skin in the game by these companies that are bidding for the business. Okay, and it may well be that a business starts off with a bid of 5 times EBITDA, yeah, but actually is prepared to pay 7 times, but hasn't disclosed that. So they're starting off at a position they think is acceptable, but through the competitive tension, if you like, with a skilled negotiator in between it, pushes again the multiples up. So there's a number of different ways. So to come back to this valuation piece, accountants will produce, generally speaking, a static number, mainly for tax purposes, but it's not a real number. It's not a real market number. Valuation comes down to a range. Okay? And to get to that range, you have to understand the EBITDA, adjusted EBITDA, what the business looks like under new ownership, and you have to understand the range of multiples that are existing in the marketplace, the average, the minimum, and the upside as well, the maximum. And basically then we're playing with probabilities and producing a range, a guidance range for a seller. And frankly speaking, Nick, you know, some sellers have numbers in mind that often exceed what really the upper end of the market is likely to pay. Those things do happen.
Bit optimistic.
And those times they have to take a view on saying, are they prepared to take a chance, or actually no, don't market the business. But the only thing that really is useful in this situation is a valuation guide range. You can't pinpoint an exact number.
Got it. And is that a service that your firm offers? Do you offer standalone valuation, or would you only complete a valuation in the context of a full mandate to find a buyer and to sell a business?
Yeah, thank you. The latter.
The latter.
So we wouldn't do a standalone valuation. Frankly, it's not worth the effort.
No.
You know, because
it's a lot of work, and the cost of it would seem, unless somebody's committed to a process, it seems a bit,
Yeah, it's, if I could give you a little bit of nuance to it, you know, you can take somebody's financial accounts and produce, you know, a profit and loss, cash flow and balance sheet. It's easy to do that. Okay, what's far more time consuming is understanding what's necessary to come up an adjusted EBITDA number under new ownership.
Sure.
Now that requires a lot of to and fro and a lot of interface with the seller, yeah, to get underneath where costs might change.
Sure.
It's not a 5-minute exercise. You know, you might spend a few working days, it might be a week or two, just on that piece alone with the client face to face, looking at individual items on the balance sheet, looking at the profit and loss statement, going, well, how would that shift? You have to model out. Sometimes you have to lean on the seller. Sometimes we're selling a company where we know that, let's say, the dominant influence on profit is purchases. Maybe it's a high volume business and we're going to sell it to a strategic buyer. We know there's going to have better buying power. Yeah, we might have some insight into what that buying power advantage might be, but the seller might have some expertise in that area and saying, well, if that company bought us, we know that they can buy at 15% less than we can. So this is part of the example of how doing that kind of valuation range is time consuming. So as a standalone piece, it just wouldn't be economical for us to, you know, charge it out at the rates we would need to do.
Sure.
And it's just not worth it without an exit. So it's all as part of one package.
Yeah,
yep.
Right.
Okay, Nick. So that brings the valuation piece to a close. So I think if there's one final piece that I'd like to just leave, and that's to summarise that valuation ultimately really comes down to that final price that's known at the end of a deal. In other words, a seller, despite their real interest to know the exact value of their business, is never going to know until that deal is done. In other words, the business is taken to market.
Only the market knows, right? That's the only test.
Only the market knows. So
Yeah.
whatever value they've been given by whoever,
Yeah.
then it should be held as being, well, possibly
Indicative.
Go to a good corporate finance M&A firm, you're going to get a range, and that's actually likely to be a lot more accurate, a lot more representative of what it's likely to be. But ultimately, it comes down to that final deal when the business is taken to market, then the price is known. But anyway, hopefully that's added a little bit of insight for people. So thanks for your time, Nick.
Really useful. Thanks, Justin. Cheers.